This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guests today are Jason Gerlach and Chris Stanton. Jason is the CEO of Sunrise Capital. Chris is the CIO of Sunrise Capital. For those of you that may recall, Sunrise Capital is the first firm profiled in my book, The Little Book of Trading. The experience at Sunrise, the systematic experience at Sunrise, the trend following experience at Sunrise goes back to the 1970s. I've had the good fortune to learn a ton from everyone and anyone associated with this firm. I'm especially fortunate, coming on the heels of Brexit, to have some very, very keen insights about what went down. I hope you enjoy this conversation with Jason Gerlach and Chris Stanton. One of the biggest political events in our lifetime, June 2016. Here you guys, an investment management firm, how in the world do you deal with all that chaos? Because I can turn on the tube and I can look at all that chaos on the day of Brexit. Everyone in the world is just panicking. And surely you guys don't like these situations as well either, but you've got a strategy from the ground up that really puts yourself in a position to either do well or minimize the downside in a period like Brexit compared to other investment strategies. Let's tear this apart.
Let's take this in two parts, all right? It's important to understand when you look at systemic events that rattle the markets at their core, it's important to understand that they fall into two categories, right? Those that are foreseeable and those that are totally unforeseeable. For example, the sudden sell-off in the Dow and the S&P that occurred last August, okay, August 2015. It was a terrorizing event to the markets because not only did it have an incredible amount of velocity, momentum, and not only did it destroy an incredible amount of wealth around the world, but it did it out of the blue, without explanation, and it was kind of like this silent killer, right? No one knew what it was, right? It was like a virus or a plague that was, you're watching the population drop off and the doctors are struggling to figure out what the heck is going on, what is actually causing this. And so that type of event is let's just call that the unforeseeable surprise event, all right? And there you have a certain set of ways in which you can react. Now let's pivot for a moment and talk about Brexit, because that's the other type of event, and that is a foreseeable one. So for months and months, this thing was sort of looming, and as the event itself became imminent, two things occurred which I found really very interesting. Number one, the market began to focus on first the polls, which were swinging, right? I mean, at one point it sort of looked like the Leave camp was going to win, and then it was swinging back to the Remain. And it was very, very obvious to me that the market was beginning to position itself aggressively around those polls. So what winds up happening is in the week leading up to the vote, right? So you have let's dial back 2 weeks in time in front of that vote. You saw was sterling trade off from 147 all the way down to break 140, right, for the first time. So in a very, very long time, we were breaking through 140. We went 7 big figures, 8 big figures, basically straight down, all of the crosses. Euro sterling was reacting, sterling Swiss was reacting, sterling yen reacting. And at the same time, there was a pretty aggressive equity sell-off, you'll recall, right, and bond pop. And then all of a sudden, as we moved into the sort of into this sort of 5 trading day gateway in front of the vote, everything swung the other way, right? In comes a poll and the focus on the bookies. The bookies are handicapping this thing. The bookies are handicapping it. And increasingly, I'm listening to people focus on the bookies. But here's the thing you need to understand, and it's important that people recognize this even in systematic firms. Systems control the trading ideas. What they do is they give you a statistical edge in creating your trading ideas. So other folks are out there performing whatever set of financial jujitsu they perform to come up with their global macro book a global macro view rather, and then to position their book. Whereas systematic traders, we don't do that. What instead we do is we say that there's intrinsic intelligence in the data. We mine the data and information out, and we say collectively it doesn't matter who's right or wrong. What will manifest itself in the right or wrong will be the price action. And so our system's positioned according to the price action. However, in this instance, what you had was a pretty nasty V. You had a move down in the week or so preceding the vote that was ultimately going to be the correct direction. And then you had a move back the other way, all the way up to 150, a new year high we made. We need a new year low and a new year high within 10 trading days of each other. Now understand something. I don't care what kind of trading you're doing, whether it's positional, macro, discretionary, or it's systematic. That is a tough set of facts. Most importantly, as we look at this, at the end of the day, you have a portfolio manager, and the portfolio manager is looking at the portfolio. How you aggregate risk, whether it's through discretionary trades or systematic trades, what I found incredibly irresponsible about the Brexit vote was that people ignored the fact that that became a binary coin toss by the end. By the end, the polls themselves were only split by about 120 basis points. The thing was swinging like 51.2 against 48.8, and the bottom line was nobody knew which way this thing was really going. And so for people to begin to hedge their books and aggressively take risk into that event, to me, was baffling. It really was mind-bending, because I kind of looked at it and I said, what we did know, and this gets to my very first point, was that whatever happened was going to be a massive event. You referenced it as perhaps one of the biggest things that's, that happened in our trading lifetimes. I began trading in 1993, and it certainly stands out as an incredible milestone in my 23-year career of a singular event that will have incredible ripple effect in the economy going forward. What I found remarkable was the cavalierness with which people were just assuming a vote, which polls couldn't predict with any accuracy was going to come one way or the other way. That led to what we saw in terms of velocity and pain, right? Because not only were people heavily positioned, they were positioned the wrong way. So not only had they taken the hedges off, they had actually placed bets, directional bets, which ultimately would prove to be wrong when the vote came in. And that exacerbated the move.
On a coin flip event, that is severely irresponsible.
That is, right? I mean, think about it. Take a step back and consider that for a minute. You didn't know Lehman was about to go down in 2008, did you? I didn't. And it just hit the newspaper that morning. And the market started to roll over. People started to see an increase of credit default swaps started to move. Like, some of this was telegraphed. But then the singular headline was Lehman is bankrupt. Bear Stearns is bankrupt. Merrill Lynch is bankrupt. AIG is going to be bankrupt. Citibank is going to be bankrupt. And what we saw? We saw the entire global banking system from ground zero inside the United States falling apart. And no one being able to meet the obligations on the other side of the balance sheet. But that was a surprise. It wasn't foreseeable. So what happens is, if your portfolio is in position that way, you initially lose a substantial amount of money. And then if you're systematic like we are, you switch. You don't fight it, you don't argue, you don't fit. The systems just tell you that this momentum is too much, statistically significant, get out, get the other way. And we all benefited materially from that. It was definitely a time when systematic trading stood out as excellent, right? As maybe not wholly and entirely, but lots and lots and lots of really qualified systematic traders did very, very well in that environment. But the point is, there was a surprise there. Here, I just found it very interesting that people were viewing this event, which had incredible downside potential, as we all found out, and sort of saying, well, the bookies have it, going the other way. What does that even mean? Does that mean some degenerate gambler somewhere placed enough? I mean, who bets on that event? Take a step back, right? It's like, so enough people like, oh, let's get some money on the Brexit vote, so they ran out and put some money on it, and then you position your multi-billion-dollar hedge fund directionally based upon what some slew of gamblers are saying. It's ridiculous. When you actually disaggregate it, it's just ridiculous. And so that event, I thought, was very, very interesting for that reason. We handled that event a very specific way over here inside the shop because we knew the markets would move very, very aggressively. We knew our systems would respond, and so we wanted our book to be as light as possible and unencumbered or otherwise hedged going into it because it was a binary coin toss.
You talk about in one of the letters you sent out to your clients after Brexit, you talk about the idea of modeling the potentials. What are the potentialities that could unfold? But that is also inherently built into your systematic approach from the ground up.
It is, because basically we're relying on assumed price distributions, right, and the probabilities of achieving them. So at its core, what a system is doing, in essence, once it takes risk, and certainly the way it manages risk, right, is we have a very deep statistical understanding of price distribution, the way prices manifest themselves once they get rolling, the way the wave tumbles into the shoreline and how far up the beach it goes in the white foam before it draws back out. What we knew was where we were likely to be in that distribution if this event went the wrong way. So that gives us the ability to be predictive in some sense about how far prices are likely to stretch if this goes one way or the other way. And in that way, we can prepare ourselves very, very substantially, because ultimately, yes, this is all built in. We don't need to second guess this. But, when you have an event like this that you're building up to, this is a really unique event in a bunch of ways, I have to tell you, because I won't call anyone out on the carpet here, but I will tell you that in the systematic community, there were certainly different approaches to this. There were kind of two camps. And one camp was just let your systems run and hope they get it right. And the other camp was be very, very conservative about the way they get to take risk in the first, say, trading session following this thing, which simply means dial down the volatility a little bit. Tell the system it's about to get into a the system doesn't know. It doesn't know what's about to happen. We do. So even though it's looking backward and measuring vol over a certain period and scaling positions accordingly, we're able to step in and say, hey, that vol is much higher than you think. Just assume for the minute the vol is 3 or 4 times what you think it is. Now, how would you scale your positions, Mr. System? That's the type of information you can feed back into it so that your system is, remember, the benefits of systems, and the reason why I believe in quantitative trading so strongly ultimately is the discipline in them and their ability to process information that humans simply cannot. My system can respond to information that no human on earth can. It's just not possible. It takes you 2 seconds to make a decision and react to stimulus. That's a medical fact. It's not debatable.
Let me run down a list really quick. I just love this list. It's in some of your marketing materials. I can look at events. Here we are. We're talking about Brexit in 2016. But you can also tell me a story and talk about performance and risk management. You can tell me an exact story about Q4, 1987 Black Monday. We could talk about the WorldCom scandal, 2002, quarter 3. We can talk about Iraq invading Kuwait, 1990, Q3. We could talk about the summer of 1998, the Russian default, long-term capital management. We could talk about Y2K anxiety. We can go back to the dot-com bubble bursting. All of these things become great, most interesting stories in hindsight. But what's so interesting about the systematic strategy is regardless of these events, which we can never really know exactly in advance, your type of strategy seemingly navigates these treacherous waters. I mean, look, it's not only about making money. As you mentioned many, many times, it's about the downside. I still find, after 20 years of being in this space, to look at how this style of trading unfolds across surprise events, or maybe not so surprise events like Brexit, it's still just amazing the lack of acceptance.
It's interesting, I don't want to. I'll digress for a second. You sort of have CNBC maybe running in the background of during your trading day. I'll look over, and there's a lot of debate going on with some of the bigger thought leaders in the tech space about artificial intelligence. Is it a good thing or is it a bad thing at a high moral level? I suppose. I think that there's a human reluctance to accept that machines can do certain things much better than us. And in the case of quantitative trading, I think the argument is something like, we're not saying the machine is better than a person or not. That's not what we're saying. What we're saying is it's an insanely powerful tool. You're talking about a tool that enables you just to do the work of thousands of people in microseconds. What would a room full of analysts look like that could digest the price action of 87 futures markets simultaneously moving double digits within 6 minutes of a substantial change in information, right? Because that's what happened when the vote swept in and all of a sudden the last sector reported and everybody realized, this has swung too far and there aren't enough remains to offset the leaves. All at once, My screens, when I looked up at them, I tried to find a market anywhere in the world that wasn't either up or down 10% or more. And that's the energy sector, the bond sector. Every single thing that's traded moved one way or the other 10%. What human being can react to that? We have a stack of insanely powerful server computers that reacted to that, right? Crunch that information with a preordained set of rules, with a pre-assumed price distribution, with assumed probabilities of the likelihood of swooping out into those distributions, and responded to it and traded it. And that's the idea. The idea is that, and basically, and stuck to it, right? Stuck to their discipline because they are slaves to the rules you give them. And that's the thing, right? Under pressure, under duress, humans make different decisions. First of all, you say, why is it that, there's two parts to that statement, right? You said, first of all, why do the machines do well? Why do quantitative strategies do well? They do well because they have well thought out disciplines and rules, and a lot of homework has gone into planning for just these types of scenarios. And they know how to respond to them. And humans under duress, we know, don't do so well sometimes. That's why duress is a defense to murder, okay? We accept that humans make bad decisions under duress. That's part one. And then part two is having the speed and the ability to process the information and respond to it in a timely way. Part of that sentence, let me unpack this little tip, that train has left the station. If your computers are not making the trading decisions for you, that means you're trying to make a decision and compete against my system, which can execute a trade in a fraction of the time it takes you to blink your eye. So how do you think you're going to point and click your mouse in time to get anywhere near where I already was? I'm traded, booked, settled all the way back in my account by the time you've even thought about where to click your mouse button. You're at a decided disadvantage when you're trading against, it's just the ultimate tool of preparation and study. And I think that's why. Now, why isn't it accepted? That gets to our computer's a good thing or a bad thing. And I think people always feel like, well, I can't understand what's happening there, or it's opaque. There's all these catchphrases, but time and time again, at least in times of duress, in the first window, unforeseeable panic or an unforeseeable systemic event, that's one thing. But certainly on a foreseeable one, when it gets as close as this particular one got, right? Experts, pollsters just said this is like a tie here going in. You know it's a binary event, then you're just gambling if you're taking a meaningful position. You're just gambling. That's not investing.
Let me flip it on you to another event which you can compare and contrast to. In the beginning of 2014, I don't recall armies and armies of economists saying that oil was going to collapse some huge amount, which it did into early 2016. Talk about that fantastic oil move, because unlike Brexit, it wasn't something where it was more of a slow unfolding type event, but no less important to a systematic strategy like yours.
That's right. Well, again, think about it. I think so that's right. That's a substantial move that people didn't have on their radar. And again, that's the beauty of systematic trading. When you have a substantial move, when you have these outside events in individual markets, the good thing, I think it's always important to remember, because I think people always think, this is a money-making opportunity. There's two parts to it. It's a risk management opportunity. Number one, if you were the other way, your systems will get you out with real discipline and precision and cut that loss at a pre-subscribed amount of risk that you were taking on the way in a very disciplined way. You will not bargain with it. You're not going to talk yourself out of it. It's going to cut the trade and get out with precision. And then the second piece of it is, as you move through that price distribution, expected or unexpected, the system is aggregating that information, understanding the momentum and the velocity behind the move, and responding to it and positioning itself, because it knows with each additional move, with each additional thrust of volume price action, that statistically the likelihood of going this much further becomes very, very high. And again, you're able to take advantage of something. Instead of sitting back and trying to figure out why it's moving, the system itself is reacting to it, because it all comes back to price distributions. What has been assumed? As soon as that market begins to move, as soon as that system sees the signal, sees the trading activity, the market price itself is pricing in the collective wisdom. That's the really neat piece here. It's not that systems are doing anything other than aggregating all that price information and saying, hey, everybody is concluding down here. And by the way, everybody is not agreeing with why it should be going down, right? I mean, there's all sorts of nuance to the fundamental explanation that people later spend all kinds of time opining on and untangling. The reality is what gives statistical trading its edge is it reacts. It reads the data, it sees the substantial move occurring, and it gets with that move. And it gives you a nimbleness that I feel like lots of other folks, and again, the power of the machines is to give you the ability to survey these markets constantly. It's human psychology. I mean, people basically live in the center of the bell curve in life. That's really important to understand. Human psychology, we don't live in the tails. We live in the center of our lives, basically. A tail event is you have a tire blowout on the parkway and it wrecks your whole night in a suit while you change the tire, right? No one plans for that. That's why it's a tail event. And I think that psychology to some extent transfers to the way people take risk in the markets. They never think it's going to go as far as it goes. They always think it's going to kind of stop because they're imagining life in the bell curve. The system doesn't. It has an assigned probability to move out into those tails, and it's not afraid to take risk out into them. And that gives it its edge, right? Because the markets, they tend to go further than people expect.
To take and use technology, to use computing, you're using that in many ways to take advantage of the insights that someone like Daniel Kahneman won the Nobel Prize for. I mean, he essentially said, look, most people will let their losses run and cut their winners short. And you're using technology to essentially harvest this inefficiency in the human condition. The human condition wants to let losses go forever because we all think it's going to bounce back. I mean, so at its root level, yes, you guys are modeling everything with the technology, but this comes down to just basic human irrationality. This is much of what you're modeling to find your performance and protect your downside.
Absolutely. I mean, what you're tapping into, what you've just said, which is incredibly correct, is that the markets are one big psychological experiment. I mean, people love to think of them in that sort of binary set of emotions of fear and greed. That's a good right. If the markets are one giant psychological experiment, and we accept your thesis, and I think it's generally right, like people generally fight bad news. You tell somebody they're terminally ill, they try and fight that. They try and beat the disease. That's what humans do. We fight against all odds. And that's an admirable quality. It just doesn't necessarily benefit you when you're caught on the wrong side of a trade. If you're being thoughtful about it beforehand and disciplined, all the systems are is a set of rules that were written by a person under a very cool head with lots and lots of study and research. And those rules, ultimately, if they're applied in a very disciplined way, work, as it turns out. It's just that a lot of times we're not disciplined enough to do it without the help of a machine. It saves you from yourself, in essence.
Why don't you guys go ahead and outline, because what you just described is not novel for Sunrise Capital, and Sunrise Capital in itself is not a novel firm. I mean, you guys have got some history. There's been transitions along the way, but I would love for you guys to give a few minutes explanation to the audience to describe perhaps the beginnings of Sunrise and bring it up to current day.
We didn't really clarify this, but Chris is the CIO here. He oversees the entire investment operation of this business. And I'm Jason Gerlach. I'm the CEO. I run the business side. And for lack of a better person to do it, I'm the firm historian, I guess. We go back to the origins of hedge funds, to the origins of quantitative investing, to the origins of the alternative investment industry. Sunrise is currently run by the three of us, Chris, myself, and Rick Slaughter, who's not on this call, but Mike, who you know well. You've interviewed him. You wrote him up in a chapter of one of your books. Rick launched his first hedge fund in the mid-1970s when he was 20-something years old, fresh out of San Diego State University and some graduate work at USC and San Diego State in things like computer science, artificial intelligence, etc. So he was really, if not the inventor of a lot of quantitative techniques, the co-inventor of most of them. And he had the courage of his convictions to launch something at that time. And what Sunrise really is just a continuing legacy of what he started back in the mid-'70s. We are 4 decades in and have basically just taken the core of what he invented back then and built around it. We've made it smarter. We've made it more diverse. We've made it more nimble. We've made it faster. We've obviously applied all the technological innovations that have come along since he launched it. But ultimately, we're still doing what he set out to do was to invest in a more intelligent way and try and take human emotion as much as possible out of the investment equation and replace it with something that's going to be a little more ruthless and efficient in how it makes its decisions and gathers opportunities. And that's exactly what we're still doing today. We're doing it in more markets. We're doing it in more time frames. We're doing it in more packages so that we can get our expertise into more investors' hands. But really, nothing's changed. Our goal is to try and beat markets and beat them consistently and give our investors a compelling risk-adjusted return. And if anyone wants to reach out to us, we can send materials that'll show them, how we've achieved that over nearly 40 years.
I can vouch for that, though, that some of your PowerPoint presentations have been some of my best educational experiences in the last decade, for sure.
Well, I'm glad to hear that. We work hard on those because we think, first and foremost, our job is to educate people. Honestly, when we sit down with someone, whether they choose to invest with us or not is secondary. It's always nice when someone trusts you and gives you capital, but ultimately what we're trying to do here is make the investing public understand that there's different ways to do things, that you don't just have to call your stockbroker and buy whatever garbage he's going to make the most money on and force you to own, and then watch it all go to pot in a crisis like '08 or Brexit. There's a smarter, more intelligent, more tactical way to invest, and that's really what we're trying to convey to people when we do things like your calls and podcasts, Mike, and we really appreciate what you do for the industry. The one other interesting side point I'd add is that one of the unique things about Sunrise is we're now fully second generation. Many of these firms that came along in the 70s or 80s, even the early 90s, had a problem. They were founded kind of by one person who had a distinct vision. He or she kind of controls everything. They're kind of a cult of personality. And when that person decides they're done investing, it's over. The Sunrise guys were a little smarter than that. The first thing they did, as you wrote about in your book, was that it was three gentlemen who all came together, had a really good rapport personally, and had a common view. And they shared responsibilities, they shared ideas. So that Sunrise was never one person. It was always about a team approach. It was always about a broader groupthink approach to investing. What that allowed them to do is be flexible, add talent over time, grow the firm, build it out, and create a sustainable succession plan. And that's exactly what they did. I joined in 2008, really believed in what they did, formed a really good bond with all of them, and we plotted out a specific course, and then we began to add talent according to a very specific succession plan. About 5 years ago, Chris, who spoke for most of this call so far, joined our firm and fit right into that culture of collaboration, sharing, and no single one person needing their name on the door to get all the credit. And so what that has allowed us to do is to have a very orderly succession plan here. Rick is still here, working hard, building models every day, but we have a whole team around him that supports him, that's integral to what we're doing. And frankly, two of the founders who came along with Rick in the 80s, who you interviewed, are no longer with us. They've gone and retired. We still manage a lot of money for them, and we still consult with them from time to time, but they were comfortable enough, and we were comfortable enough, and our clients were comfortable enough that the culture they built here could continue on, whether or not every single person from 40 years ago was here or not. We've really done what many said would be impossible, which is kind of carry on the legacy of this tremendous firm with a whole new set of characters in the play.
I would love to go a little more granular on some of the big picture issues of why you have this performance, why you can protect the downside volatility. I want to pick from a few big headlines in some of your work. When I see phrases like multi-strategy, multi-sector, multi-market, long-short approaches, unpack that for the audience in a way where they can understand. If you've got a great strategy, why does it necessarily need to be multi-strategy? I mean, unpack some of that for the audience.
Sure. This is Chris again. So as an initial matter, when markets were less efficient in decades past, what was helpful in smoothing your returns, in other words, decreasing volatility, standard deviation, and giving you a smoother equity curve, was to trade your system across different geographic regions and across different markets. So you wanted to deploy it in as many liquid markets as it made sense after testing where the strategy performed well. And so, there may be opportunities in base metals or precious metals or currencies or energies, things like that. Over time, what we've seen, and certainly most people will be familiar with the phrase risk on, risk off. And what that really references is a high correlation amongst sectors now. And by sectors, I mean the energy complex, like crude, Brent, heating oil, RBOB, energies, metals, both base and precious, currencies, agriculturals even, interest rates, and equities. And what we've seen is, so across geographic region, we saw, again, Brexit's a great example, you saw every index move, every equity index in the world was in the red and in the red substantially. So what you're seeing is a high correlation. And so you're losing some of that diversification. In essence, you're putting on one trade, even though it feels like you're putting on many, because it's highly unlikely that you're going to have on a Nikkei long at the same time that you have a Hang Seng short. It's far more likely, unfortunately, that they're both going to move in the exact same direction. So you'll be short both, which is effectively doubling down on the trade. Over time, as markets began to more closely correlate together, and certainly it will take smarter people than me to untangle why that happened, but we can say at a very base level, perhaps as the global economy became more integrated, right, and each individual sovereign economy became more reliant upon the other, away went diversification through global bond markets and equity markets and currency markets alike. What we understood was that the best way to get diversification back into your portfolio was you looked out at the world and you sort of say, who is successful in navigating this? I mean, sure, we certainly tried. We varied by, obviously, market, as we just went over. We varied geographically to get as much exposure around the world as we could, hoping that a different part of the world may be doing better or trending a certain way when another wasn't, acting non-correlated to give you that nice additional alpha. And then the last piece was time diversification. Run your models across different time frames. If they were looking over one time frame, make sure they were policing several. But ultimately, the holy grail we suspected of trading methodologies would be one that looked like a fund of funds in and of itself. Several systems that were non-correlated to one another because they took different trading approaches. They were actually doing different things. When you look at our trading systems, our systems today have 5 distinct families of systems. We have an algorithm that lays on top of that and allocates the cash. Every dollar is distributed across those 5 systems according to that algorithm. It's distributed. But for purposes of this phone call, it would be helpful to just think of them as almost equally distributed. And then the magic, if you can achieve it, would be to have those 5 systems behave truly differently in the very same environment. Because that's how you're going to have some of them doing well, some of them not doing well, and then the inverse occurring in different environments. So as the environments change, several systems are always thriving, a few are being challenged, but the net effect is that they are backstopping each other constantly, and that does a really nice job of decreasing your volatility if you can achieve it, and smoothing out that return. What does it really mean? What it means is, as I said, if we didn't invent trend following, we certainly co-invented it in the late 70s. We're excellent at it. There is a trend following component to what we do. There is a pure momentum part of what we do. There is a pattern recognition system to what we do. There is a larger beta grad bleed into our systems to what we do. And we now have short-term systems that trade hundreds, if not thousands of times a day to deliver alpha into our strategies. We are moving across the spectrum of techniques to make sure that if it's medium to long-term investing that's doing well, we have systems that can capitalize that. If we get into whippy, non-directional, up, down, new highs, new lows volatility, we have systems that can thrive in that environment too, to dampen the volatility of trades you may have on in your medium-term trades, systems that go from good to not so good to not so good, that deliver that volatility in your P&L that no one loves to see. So it makes the ride smoother.
Talk about leverage, risk, return. So many times people see the headlines and maybe there's this one trader it catches the news and there's just exceptional performance and perhaps other traders are lagging. Usually that's never really broken down or explained. But speak to some of the decision making that you've made for the type of strategies that you're delivering to clients right now.
When you design a system and test the system, or even when you analyze any trader's track record, so let's just focus on a real-time track record. There are certain statistics that I'm sure I know you know, and I'm sure many of your callers are familiar with. Sharpe ratios, Shortino ratios, different statistics to measure the efficacy of what you're doing. How good are your risk-adjusted returns? One of my personal favorite measuring stochastics, which kind of gets to the heart of what you're asking, is an MAR. Your MAR ratio is simply, the best way to understand it is taking your compounded rate of return, or your targeted rate of return, and dividing it by your maximum drawdown, the max drawdown that you've seen in your equity curve. And it gives you a number. And then that number gives you a sense of what you have to risk to try and achieve that return, right? That's in essence what that number is telling you. So the higher the MAR, in our view, the better, right? Because let's say your MAR is 4, which would be an exceptionally high one. You could, in essence, risk an expected 5% max equity drawdown, or an experienced one up to that point, to try and target a 20% return. And that might be something that an investor is comfortable with. Like, hey, I'd be really comfortable if I see my account down 4.5, 4.75. I'm not going to panic. There's always going to be a standard deviation around that. It's an expected outcome, and there's always standard deviations. But the point is that ratio can give you a sense. So it's really important, because if you see an eye-popping number and somebody's up 75% or something, you got to kind of investigate what the drawdown might have looked like at some point to get there. Because targeting a return is just a function of leverage. It's easy enough to do. In other words, if you develop a system with an MAR of 2, you could run out and target a 20% return or even a 30% return, but your expected drawdown would be 10 or 15% respectively. That may not be something that an investor wants to live through. It's really important. From our perspective, we can set the heat, which is now we get to the heart of leverage. We can set the heat wherever we want. We know what our expected MAR is. We know what our experience has been so far. We at least know what our investment experience has been, where we are. And so for us, particularly in the case when somebody invests in a managed account, separately managed account, we're able to talk about what they want to live with. If your MAR is 3, it's pretty easy. You say, what kind of return is optimal for you? If you really want to target, say, something a little more conservative, like a 15% return, then you can expect a 5% max equity drawdown, right? I mean, you get, it's not definitely going to stop there, right? It could go to 6 or 7. The point is, in your experience, what you've modeled for, within reason, you're expecting a drawdown in that neighborhood. And so it's a powerful measuring tool. Now because of the way futures are designed, there's an inherent leverage in a future contract. You have to put up a margin account, right? So when someone gives you the money, you have to post margin. What you do with that additional cash varies from manager to manager. We tend to keep it in a T-bill, a super short-dated T-bill, so it's basically effectively fungible cash. And we post the requisite amount of margin. But how hot you're running that account will really be how much margin you're utilizing, because futures will allow you to use a certain amount. But the point is, they're just questions you should be asking. You look at somebody's compounded rate of return, take a look at the max drawdown they've experienced, get a sense of that MAR. Where are they running the heat? And that'll give you an idea of how far they're stretching that margin to try and achieve that compounded rate of return.
And the word leverage, Mike, just is so abused and misused in the general financial services media. It just doesn't do investors any service. I mean, leverage is just something. It's not, the way it's couched, it's inherently negative. So, he's leveraged. Suddenly that person's evil or bad. Sometimes leverage makes great sense, depending on the structure of the deal you're doing or what kind of trading you do. Sometimes it makes terrible sense. But it's situational.
Well, leverage is a reality in many, many strategies, period. I mean, it just is. It's whether the leverage is deployed responsibly or not. When you buy a home, you are deploying leverage, unless you're not taking a mortgage. And if you're taking a mortgage, then it depends on how much cash you're putting down and what that loan-to-value ratio looks like. And how much leverage are you using? Right? Are you putting $300,000 down to buy a $3 million home? That's a heck of a lot of leverage. Are you putting $300,000 down to buy a $1 million home? A lot less leverage, right? I mean, so the idea is, it's about being responsible. I mean, leverage, there's nothing inherently bad in leverage. It is what it is. The product itself doesn't require you to put up every dollar. So there's a natural leverage. It's just how I guess responsibly are you deploying it? That's all. So there's nothing scary in and of itself. But, to me, part of your question was, what do you say to someone who puts up the up 100%? You put up an up 100%, my guess is you were running things pretty hot with a lot of volatility. It's my guess. I'd like to see what the max expected drawdown was over that period. What were you, in essence, having to be willing to lose in order to garner that return?
And I'm reading actually from your Sunrise Evolution program, a bullet point about a fact about the program. We've talked about this through the course of this call, but I want to emphasize this going out. So the point here, provides a solid alternative to the massive downside volatility presented by long-only and traditional buy and hold investment strategies that are common to most portfolios. So as we started with Brexit, I'd like to go out with Brexit. And I know you guys are not prediction guys, but has it opened up Pandora's box? I mean, have we reached a point in time since perhaps March of 2009 that there is no better time for people to start to really say, maybe things are going to be a little more rocky going out in the next decade? It sure seems like it. Again, I know you guys are not prediction guys, but why don't you speak to this? Because a lot of people are really, really interested in those perspectives right now.
Let me say this, all right, and this is really important for people to wrap their heads around. We have a theory inside this firm that goes something like this. About a decade ago, a little more, things changed in the world in a secular way, not a cyclical way. It's very important for people to understand that. I talked in the beginning about price distributions and the way prices manifest themselves. We believe that price distributions started to change sometime around 2003, and the change in them has been escalating materially over the last decade. We believe we understand what caused it, though we are just frankly guessing. We have crunched enough data, and we have a good enough understanding that we believe we can empirically prove to anybody that prices have changed. And the way that you're feeling that is the following. If you look at a distribution curve and you assume that it's a bell curve, a Platypus curve, your typical bell curve, you expect the tails to look a certain way, your sort of typical bell curve. If you were to steepen the center of that curve, pull the top of it up like a silo on a farm, but make the tails much fatter, the curve would begin to look leptokurtic. And what that would mean is that you would go through periods of time where seemingly volume was infinite. You could trade €1 billion without moving the euro more than 3 or 4 ticks, and then all of a sudden, at the snap of a finger, it goes away, it evaporates, and the euro skates, big figures at a clip. That is the world we live in. We live in a leptokurtic world now, and we believe it is here to stay. That makes Brexit just another reason. The Brexit is not being. It's always going to be something else. There'll always be another thing. And yes, I'll talk a little bit about Brexit in a second. But the point is, when these shock events hit the system now, prices move further and faster than they ever did before. That is a real problem. That presents a real challenge. Let's not call it a problem. A real challenge to traditional portfolios, particularly if that price move is adverse to, simpler, more typical, historical, long-only type buy and hold strategies. So what's happening now is singular events, that little pebble's causing a disproportionate ripple into the pond over and over again. And as I said, it's because of a secular change in the way that people take risk. It is not going to undo itself. All right, we're not going backwards. It is going to get harder and more volatile and scarier. It is not going the other way. We will go through periods of low vol seeming grind where things won't move at all. Think taper tantrum. Think taper tantrum, May, June 2013. We were seemingly grinding along, everything was fine, and wham, off with the markets into a fiasco over that announcement, but they moved in a disproportionate way, in an exacerbated fashion. Think August. Think January, February this year. Why did the markets go from sitting in 8, 9, 10 handle ranges in the S&P to shooting hundreds of handles intraday? Not just the 120 handles down, the 70 back up, the 60 sweeping back down. If you start to look at the intraday volatility in those ranges, in those days, they are extraordinary by any historical measure. That has changed. So now Brexit. Okay. What Brexit did, that vote did, is a whole lot of nothing, but a whole lot of something potentially. It's important to realize that they didn't do anything other than give an advisory referendum to the next prime minister to potentially follow. When you look at it and you say, holy cow, what does this mean? The answer is you don't know, and nobody knows. For example, let's say they choose to exit, all right? If they choose to exit, what we can expect is we say, well, if they choose to exit, that'll be bad for the economy. Why? Well, they'll get worse export deals. Well, we don't know that because they are a massive military power, and maybe they will trade that as they're one of the gatekeepers to keep Russia back in Europe as a piece on the chessboard against better export deals. I mean, we don't know. Maybe they'll say, hey, we'll help out in the IMF if Greece goes underwater again, or we won't if you guys give us bad deals. So we don't know what those negotiated deals will look like. They could be worse than what they have now, which is what the market's assuming, by the way. They could be the same or better. We just don't know. And so as you start to look out, what we do know, and that's why I started where I did, was as that information comes in, those rocks will hit the pond, and the ripples they will cast will not look anything like the ripples that people are used to. They will have an exaggerated response in markets because of the secular change in the way prices manifest themselves.
If you believe all this, though, there is no way that someone listening right now, you don't get the benefit of having the systematic strategy after the event has occurred. Meaning, you need to have this mindset, this philosophical mindset, and a strategy in place before the unexpected happens.
You could think about it in essence of, I mean, if you say, well, if we hit a massive pothole, we'll add shock absorbers to our car at some point. That's not going to help you, right? Your chassis will be bent. You're going to want to have shock absorbers in place. There is no strategy that's guaranteed to make money in these super high vol, scary environments. But at least the time-tested one, the one that has appeared to be able to handle it in the past, are quant strategies. Quant strategies appear to be fast enough, nimble enough. That's what history is showing us. It's showing us that they give you a chance to have something in your portfolio that has a high probability, I think personally, of being able to help you out in some way. And that help might not be making money, it might be losing less, I don't know. But the fact of the matter is, what I do know is that we personally believe, and certainly we're biased, that it's an important part of a balanced breakfast. It should be a part of your portfolio. You should have some quantitative strategy in there. Pick one, do your research, find one that you believe in their strategy. I would add a sleeve to your portfolio because, frankly, though past returns are not indicative of future results, they certainly helped folks out in 2008 at least in that set of facts. And we don't know if that set of facts will replay itself, but the fact of the matter is I think it's a nice part of a balanced portfolio. It appeals to the environment, but no matter what, fortunately, we strongly believe here that we have turned a very tricky corner in the markets, and you can feel it in there. It's not, things are very, very sort of high octane right now, strung very, very tight. And you ask, well, everyone's trying to come up with a reason for why. That's the elections. It was that Brexit thing. Everyone's, it's the war. There's been a dull hum of a war going on since 2001. And, no matter what you try and put your finger on, no, it's something else. It's the velocity and the extremeness that the market is moving in. And frankly, it's even its inability to follow through. Just deliver that right amount of pain to get everyone to exit and turn right back around and rip right back up towards the highs and make everyone look at it and go, gee, that just made, we walked in one morning in January, so we had just endured August, September, and October. I'll remind everybody that on the turn of August to September, oil, base metals and oil moved 29% in under 72 hours, the biggest single move in the history of oil, and that was up, by the way, before going back down to retest the lows. Who stayed in a 30% correction before it went back down, right? How did you stay in that? You thought about volatility in your returns, right? So the most aggressive of markets, midway down that collapse on the way down into the turf in January, some sage guy jumped on CNBC and shouted, "Go to cash! Go to cash! We're recommending you go to cash." This is a large, massive institution, one that had a platform enough to be the only face up on CNBC. I thought to myself, I hope nobody's following that man's instructions. Because, sure enough, in went the low and back up we went, all the way back up to retouch the highs. The market was not suffering fools, right? What it was doing was generating just enough velocity to scare and volatility to scare every living soul out of it, it seemed.
And Chris hits on something really important there, and it goes back to your very specific question about when you have, it's a bad idea to get the insurance after the catastrophe. The problem is investors is they never like to have something in their portfolio that's losing money. They can't. It just drives them crazy. If the stock market's going wild, if there's something in there that's not making money, well, it's what's wrong with that? Let's get rid of that thing. But that's the whole point of diversification. If everything in your portfolio is making money at the same time, it feels good, but you're not diversified. You're not ready. You're not ready for that crisis. You need to have different things acting differently, and you need to see some red numbers in your portfolio almost every day from something, because that means you're probably well diversified. And the point we try and make with our products, and what we're trying to achieve for investors, is to give them enough diversification so that those bad events don't scare them into doing something completely stupid. If you have a highly concentrated oil bet on a day that Chris mentioned, and oil goes in that direction, very few people have the courage to hold on to that investment. But if it's a small piece of what you're doing, and it's managed tactically by someone like a Sunrise or a similar type firm, we're going to muffle that downside just enough so that you're not going to go against your best interest and sell the thing you shouldn't be selling. You're going to ride stuff out. Our investors in our equity program are going to ride out Brexit. They didn't panic, we didn't panic, and we're still in the game. And now you look at our numbers at the end of the month, and we're okay.
Yeah, I mean, I think that what you see in the numbers, and that's why we sent around those special reports day after day after Brexit, was that we knew that our investors would be sitting on the edge of their seat thinking, oh my God, the Nikkei was down 11% last night, okay? Everything in the world was down incredible amounts of money. What happened to my hedge fund? What happened to my, any of the products? And we sent them out, estimates each day, our best estimates to try and give them some comfort and let them see that what was happening is we were succeeding in dampening volatility. That's for sure we were succeeding. I'm not allowed to discuss numbers, and I won't, but the fact that we would certainly make them available to anyone who wants them. But the fact of the matter is we dampened the vol, and we performed very admirably, we believe, and it was because of this diversified set of systems. No, we didn't. If you're looking for the binary bet, we're not that firm. But if you're looking for a set of systems that has I always think of my set of systems as the Oakland A's, right? They get on base every which way over and over again. They just beat the heck out of you. Whether they get hit by a pitch, walking, hitting some nickel and dime single, and we do have the guy in the lineup that can put it out in the seats, absolutely. But just like any four-spot hitter, that hitter's striking out, we have four other systems that are in there just nickel and diming you all over the place, getting runs on the board. And that's the idea.
Guys, I appreciate it. And I have to tell you, I still, and I mentioned it already, but I'm looking at it right now, and it's a page from your PowerPoint presentation showing crises going back over the last 20 years. And as I mentioned, some of the names earlier, from the Russian default to the dot-com bubble bursting. When you look at that one page, and look, I'm not selling anything, but from an educational perspective, to look at those events in an ordered list, in a snapshot, take in the information, it's got to cause anyone and everyone with a pulse to say, whoa, what's going on here? You have the typical buy and hold approach is doing this. There's these alternate approaches doing that. And that alone is just such a damn educational moment. At least for me. Maybe I'm just an odd guy. I don't know.
It gets back to the human psychology. You ask the question, why isn't, at some point along here, you ask the question, why isn't quantitative trading more widely accepted? Who knows? Maybe there's obviously some psychological barrier, but the reality is that, the results are undeniable. You have to understand that, all you can do is look back at what they did on certain singular events, as you said. And, it's not just our firm, it's many firms like ours, seem to be able to capitalize to some extent on those events. I think Jason hit on a very important point, which is, people tend to put something in their portfolio and then obsess about it. Why isn't this doing anything, or why isn't it making as much money? It's funny. My favorite thing to hear out of anybody's mouth is when they tell me that, well, after 08, all you had to do was sit in the S&P and it all came back. We made new highs. Yeah, after you lost half your money. Half of your money was gone. So after half of it was gone, and if you didn't need it, the other half, then yes, you could sit back when you got out from under your desk or your bed and out of the fetal position and watch the market recover at the hands of the central banks in the world. But frankly, who wants to do that?
It's easy to imagine as well. I think for all of us, it's easy to imagine if we can see the S&P drop these two big drops that have happened in the last 15 years. It's easy to imagine a third big drop. It probably will happen. I can't predict that. You guys can't predict that. But that's the way of life when you look at the data. The data shows us that these historical moves on the downside from a long-only perspective happen. And it will surely happen again.
We've had 4 in the last 10 months. More wealth was destroyed on Thursday night than any other night in history. $2 trillion destroyed globally in the markets in one night. How's that for leptokurtic price action? Leptokurtic enough for you with correlations? $2 trillion gone globally on that night, mark to market. That's not me, that's CNBC. What I would say is that's a pretty big move. Somebody was selling, somebody panicked and got out, right? Evidently, lots and lots of people panicked and got out. I just think that it's helpful to maybe have a piece of your book that won't necessarily won't respond in the same way to that panic that a human would.
Guys, where's the best place we can send everybody? sunrisecapital.com?
You bet. That's a great place to start. info@sunrisecapital.com is an email you can write to and ask us for any information you'd like. www.sunrisecapital.com is the website.
Guys, I appreciate it. It's always good to chat, Jason.
Michael, thank you so much.
Yeah, absolute pleasure. Thanks for hosting.